Excellent. Let's hope it holds. Let's hope it holds. Great. So good afternoon again to everyone and welcome to the second event of the Caribbean Association of Banks Masterclass series. Today's topic is one that has generated much interest and discussion given the developments that have taken place within the region's industry in recent years. With the exit of several long-standing international banks, it was heartening to witness the forward engagement of our indigenous banks to hold discussions that would ultimately lead to the mergers and acquisitions of newly available banking operations. This, of course, speaks volumes of the tremendous growth of our indigenous banks and signals a robust future for the region's industry. As it concerns correspondent banking, I can sincerely say that the CAB has left no stone unturned in the quest for identifying and addressing related challenges. Today's session is yet another example of our efforts as the potential benefits of the development of a correspondent banking playbook will be discussed. I would like to note that the CAB is also currently engaged with CARICOM concerning a regional correspondent banking playbook, as we are well aware and of the view that every avenue that may alleviate and hopefully bring about an end to the continued de-risking activity should be explored. The first session this afternoon of our masterclass shall focus on the topic of mergers and acquisitions, and I will briefly introduce you to three esteemed gentlemen who are amongst the foremost in their fields. Firstly, Bruce Bowen. Bruce brings to the table approximately 25 years of banking experience with Nova Scotia, during which time, of course, I had the pleasure of knowing his name personally. He worked extensively in leadership positions in the bank's operations in the Caribbean. In 2016, Mr. Bowen left Scotiabank to establish Rock Capital Partners, a boutique investment bank and fund manager dedicated to expanding access to financing for Caribbean businesses. In 2017, Mr. Bowen founded Advantac, which is a technology-based managed service business with a vision of providing regional and community financial institutions the benefits of technology and technical expertise traditionally beyond their capacity to fund. Secondly, we have Mr. Jim Meek, also a name that I would have been familiar with. As a career banker with over 4 decades of industry experience, he has served in the capacity of Senior Vice President International Banking with Scotiabank Toronto, where he supervised Peru, Egypt, and 8 countries in the Caribbean region. Mr. Meek also piloted 3 international banking integrations in the DR, El Salvador and Peru, which focused on restructuring board policies and fostering compliance. Most recently in 2011, from 2011 to 19, Mr. Meek served as board chairman for Scotiabank Peru, Chile, Mexico, and Peru, where he spearheaded innovative projects integrating new policies, procedures, and programs that maximized banking operations and risk management. And he's currently a member of the senior expert team of Digital Financial, which is a boutique consultancy with global expertise. And thirdly, but certainly not last, I have the pleasure of introducing Mr. Dalton Lee, who is a career banker and accountant. He is the principal of Vanandi's Business Consulting Limited LLC, which provides financial consulting to small and mid-sized companies in the broadcasting, banking, financial services, e-commerce, and entertainment industries. Mr. Lee is one of the founders of Bank of Montserrat Limited and currently serves as chairman of its board of directors. In addition, Mr. Lee is the chairman of the Caribbean Association of Audit Committee Members, otherwise known as CAACM, as well as the trustee of the Caribbean Court of Justice Trust Fund, CCJTF. Mr. Lee has also held positions of increasing responsibility with Bank of England, now Bank of America, after starting his career in banking with Barclays Bank. With that introduction, you would recognize that you have been placed in very, very good hands with sound backgrounds in the discussion topic this afternoon. And so I'm very pleased to be able to welcome you again to our sitting this afternoon and hand you over to Mr. Bruce Bowen, who will kick us off this afternoon. Thank you again.
All right, great. Thank you very much, Wendy. And to my fellow panelists. And Wendy, shall I share my screen, or is someone else going to put it up?
Yes, you can go ahead.
Let me do that. Do it this way. So again, I'm going to keep my comments fairly short. And again, thank you very much, both Wendy, to yourself and to CAB for inviting me to speak. I think the topic is very timely. There's obviously been a lot of activity in the region, at least relative to what there had been for many years. I am going to try to keep my comments reasonably short and hopefully stimulate some topics that could that we could have discussion about afterwards. So I thought where I would start is just recognizing that any M&A, any acquisition has a number of different stages to it. First of all, there's the transaction itself, and any good integration is going to start with very good due diligence and understanding where are the risks in the transaction, in the target entity or in the two entities, and making sure that you have a good understanding where those risk areas are, whether it's credit risk, quality of the portfolio, compliance risk, or others. And then there's a transaction signing. Then, and I want to lay this out, there's this period, what I'll call transition, from the date of deal signing until the actual hard closing. And that is time usually, especially in financial services, can be an extended period of time because while there's a lot of preconditions that need to happen, the biggest one typically is the regulatory approvals. And the best integrations I have seen use this time very well. Make sure that the right integration team is set up and put that plan together. Both parties have a vested interest in seeing that the transaction, the integration happens smoothly, and therefore, even though the transaction hasn't been finalized, there's a way to make sure that the plans can really be developed, that the strategies are in place, and that there's that. The key is that first 100-day plan or 90-day plan, whatever it happens to be, so that before you get to the actual legal closing, your team has a very good idea of what needs to happen. During integration, post-legal closing, there's always a brand launch, both public and internal, and then it's executing on those integration plans. But then also, if that integration would typically take 12 to 18 months, there's going to be after getting through all of that, what I call optimization. In other words, you typically go into an acquisition or a merger with an idea of what your synergies are going to be. Have you achieved them? And if not, there's still work needs to happen to ensure that that is done. And then just an assessment of the process to ensure that all those things you were planning to achieve initially in terms of obviously synergies, but also new business growth and new opportunities. We don't go into acquisitions typically just to save on expenses, but there's opportunities to leverage strengths of two institutions to expand on the customer and revenue side as well. Critical success factors from my perspective, and critical success factor in any business is leadership. You need the right there's always an integration or a team that's handling the integration. Both the leadership of that team and the key members of that team are critical. There's always a struggle between I need my best people continuing to run the business and generating the revenue and servicing customers. On the other hand, you need really strong talent working on the integration, because a poorly led integration has long-lasting impact. But you need top talent from both institutions as well, feeling that the acquiring institution is going to provide all of the talent. I challenge anyone to say they work for a bank that has more than enough talent that they can run the day-to-day and do an integration. So it's how do you leverage the top talent from both institutions? Ability to lead through uncertainty. It's obviously a time, and anyone who's been through it knows there's a lot of people go through fear and uncertainty, and it's maintaining morale through that process. And it needs some dedicated expert resources. And again, few would be the institutions that don't need to pull from the outside on some dedicated resources to ensure that that you can both manage the day-to-day business and handle the integration. Number two, starting with a detailed, well-designed plan, and that should be developed through the transition process. Again, change management, clear, consistent, strong communication, being very clear on what the targeted culture is, and making sure that you're communicating to maintain that, because during the stress of an integration, people don't like change. There's always a lot of uncertainty, and making sure that from the CEO down and through the integration team, there's more communication is always better. Quickly establishing the new organization. Certainly our experience in Scotia, I'm sure Jim will reinforce this, is you'd always hear these arguments that, well, you got to allow, take some time for things to happen because you don't know what it's going to look like. Every time, both in banking and since leaving banking and other companies, there's always this feeling of the target company, oh, you got to maintain my brand, you got to do all of this. The sooner you establish the new organization and get through that pain, the quicker you're able to start building up and getting into a business growth mode. And making sure through the whole process you stay focused on customer needs, because we still need to make sure as an organization we're generating revenue, we're servicing our customers, we're building and building our customer base. And common challenges. Communication, we talked about that, making sure that it is well thought out, well executed, as much communication as you think you need. I am sure, need more. Identifying during that transition period key employees and key customers, that it's critical that they're retained, and making sure that a lot of focus happens to ensure that those customers and employees that are key to the business are happy, and a lot of communication to them. Maintaining focus on what's important. And again, that's that balance between the day-to-day and the integration. The reality is you have to continue to do both of them, and that's why resourcing is so important. And the rarely would institutions be able to do both well without some additional resources coming in, being contracted. And then the last one is the cultural integration. And I'm sure we all recognize that a culture of an organization is extremely valuable, and it's kind of like brand, one of those things that's an intangible. But through an integration, through an acquisition, it gets challenged and it gets stressed, because people who felt that the culture was one thing are going to feel uncertain because they don't know what's happening. And it's important to make sure that in all your communication, you're very clear on the culture you're trying to build, or most often maintain, because again, the culture can slide easily through it. So they're having the benefit of going first and being able to put just a blank sheet of things out. Those are the key points that I want to put out there. And other than that, that's hopefully stimulated some things, and my fellow panelists can, afterwards, we can have a discussion on those points.
Absolutely. Bruce, as you spoke, I jotted down a few questions, but I do want to keep the conversation going. So thank you so much for that. I'm sure that I will target you in some of these questions specifically. But we may have an opportunity, of course, to have your fellow participants join in their presentations as well. So why don't we go ahead? I'll allow Jim to go ahead with his presentation at this point. Dalton, you're up hot next.
Okay, thank you very much, Wendy, and thanks very much. I'm going to build on what Bruce has said. I agree entirely with what Bruce has done and what is said here. I'm going to talk about a lot of the same things, but I might take a little different approach on it, if that's okay with you. Okay.
Absolutely.
Our next slide. Who's doing the slides?
I believe Terry is doing
Terry will take you through. Sorry, Jim, we're having some bandwidth issues, so I'm keeping my camera off as much as possible, but Terry will take you through.
Okay. I'll go on the next slide too. This is about digital financial. Lisa, did you want to say anything about it?
I did briefly. Thank you very much. First of all, I just wanted to thank Jim. He is not a member of or employee of our firm. He's been very kind to come onto this event to share his many years of experience in the area of integrations. So many of the consultants of our firm had the pleasure of working with Jim and other senior members from the Scotiabank team. And thank you again, Jim, for coming on. And the other thing I'm going to just chime in here is, having had the pleasure of working with Jim on putting together this deck, absolutely, there's lots of things that he is going to support, exactly what Bruce said on. But one of the things that Jim brings to this is some really great sort of tales from the trenches, which show the real applicability about what he and Bruce have both put forward. Thanks, Jim.
Thank you very much, Lisa. Now I'll just go to my first slide. And the next slide I meant. This is, I wanted to put this slide up, as I mentioned to Lisa and to Peter. I wanted to kind of make sure from Wendy, your master class 3, that they would see kind of all the components. Bruce has talked a lot about similar things, but I wanted to put it down just to see, for example, how big and how complex this whole thing can be. You know, successfully managing an integration involves a coordinating and complex range of activities simultaneously across every facet of the organization. And this really does the trick. I mean, it just shows you how much. You look at the first business line as an example, the retail banking. When you look at the key support functions, everything down that right side, the key support functions would impact on retail banking. And then you look at sales and service. Then you look at commercial, corporate and commercial, the same thing. There's so much that is all linked. This is the big picture, a lot of moving parts, but it's linked in a very big way. And it's only as strong as the weakest link. If something goes wrong in the brokerage side or the credit card and debit card side, it could impact so many different areas. So when doing it, and Bruce talked a lot about the due diligence, and I will too in just a minute, it's how it's all comes together. And the one thing I wanted to emphasize, Wendy, to your class in terms of preparing for anything, you just never know what's going to happen. And if you have a plan, as Bruce was talking about, and you have kind of an overall kind of putting it all together, that's where it would really kind of show in a very big way. But you never know what's going to happen. And this is what makes it exciting, truly. This next slide on the integration roadmap is my favorite one, and it talks about what Bruce was talking about on the due diligence. And it's so critical in terms of, you know, when you do the due diligence, and I always recommend it that the person going to be doing the management or the integration manager or lead be on the due diligence team, because they can then see exactly what and why we decided on going ahead or not going ahead on this particular situation. But there's so much encompassing in the overall kind of due diligence process. When you look at building the business case, you look at the whole strategic investment committee and what you have to do to prepare for that. But I wanted to kind of even looking at, again, remembering the last slide that I showed and how big and how broad everything is. I think of an example of a bank that I was involved both on the due diligence, leading it, and then led the integration afterwards. And it was on a bank in South America that we looked at, and it was a big bank and a big operation, but the economy was really in terrible shape at that particular point. The bank that we were going to acquire, and a European bank, had real major problems and lost all kinds of money, never made a profit in the 5 years they were there. And they wrote off so many of the loans. But when you look at, again, everything there before, of all the components, the retail, the commercial, the corporate side, the treasury side, the audit side, even on all of the product side. One thing when we came down trying to decide on this particular acquisition, and was really swaying towards forgetting about it because the economy was so bad, the other bank lost so much money, they really didn't make, until the bank decided to look at the bad loan portfolio. These were all the loans were written off. They were classified as bad loans and written off completely. But some of our board of directors from the old bank, as we were in Peru before, Banco Sudamericano, were connected very well. One of them was the Minister of Finance, but a previous board member. We got to sit down with a lot of them, including the Prime Minister, and talk about the possibility and how things were going to turn around, because they were all optimistic. And they convinced us to go ahead with this deal, primarily based on the loan portfolio, that all the loans that if the economy did turn around, which is what they were predicting, would make the difference of buying or not. And we went along with it. And they turned out to be a windfall for the bank. And in fact, the collection and restructuring of those loan portfolios was the key component to us really paying nothing for the bank in the end. Now that's confidential. We keep it confidential now, Wendy. Just kidding. Some of the things, though, after the due diligence process, when you look at it, and this is the transition, you look at the planning and the training, the business strategy, and Bruce talked about this too, in terms of the budget, the integration plan, the operational assessment, and selecting the first line management. And I'll talk more about this in a few minutes. But that is so critically important, and at this particular phase as well. And again, then you look into the integration itself and the customer retention. Bruce talked about that. Sometimes, you forget where you are when you're involved with a big integration like this one, or the one that I referred to before, or even any of them, that, you've got to kind of focus on the customer and make sure that their day-to-day, they're not stopping their business, they're continuing. But sometimes we get so involved with the integration part that we forget about our customers, and you can't. And this is such a key component. Then we look at communication to customers, communication to employees, communication to the media and the government, consisting of the central bank, or the Minister of Finance, or the superintendent of the banks. It's also critical. But on the employee side, it's really, really something else. And in my first integration, which was in the Dominican Republic, I screwed up royally in terms of how I was kind of working with our own employees. We didn't do, as Bruce was talking about, and I'll talk about more as well, the communication. And we just went in there because we were asked by the government to take over this particular bank, and I'll talk about that a little bit differently, a little bit more in a different manner. But we were asked to take over. So we didn't do the due diligence that we talked about the way it should be done. But this was our very, very first acquisition, very first integration. So we learned so much. And this deck that I'm sharing with you today was something that we built after that particular integration. And we've used it ever since. It's been modified, but this is what I built with our team at that particular time. And again, that's 15, 16 years ago. But let me come back again to the employee side. We were into the transition phase, if you will, about 2 or 3 weeks. And I had 2 senior people from Scotiabank, because we had a Scotiabank operation there, and we had this bank we were taking over, Banter. But they had 2 people come up to me and say, Jim, we want to talk to you. We got 14 people waiting in the training room. We got to have a talk with you, and we want to talk right now. I says, okay. So I went downstairs, and these 14 people were there. The 2 people were representing them and talking about, say, Jim, we're the bank that's taken over this other bank. We see you, Jim, giving jobs to the senior people, or senior jobs to the people in the other bank. We are the bank that's taken over. We demand, and this is what they said to me, we demand that we be given the jobs and not them. They're the ones that are being taken over. We're the ones taking it over. So they shouldn't get the cream jobs. So I said to them, now, before I got my blood boiling, I said to them, really, where are you coming from and what jobs are you referring to? And they used 2 examples. One was a junior person a year and a half as a teller, and another 6 months as a junior operations officer. And he stood up, he says, I like to have the manager of operations job that was given to somebody who had 25 years experience from the other bank and had worked at Scotiabank before that as well. And then the other example was somewhat similar. And I said, really? I said, what you have just described here is really in a matter of incompetence in terms of what you can actually do. But let me assure you that I said, in going forward, there'll be more opportunities than you can shake a stick at. And I said, what you'll have to do is kind of bear with me and bear with the bank going through. I'm making a long story short here, but basically what went wrong is that we did not communicate exactly what we were doing, when we were doing it, why we were doing it. And they had a very good point in terms of demanding. I didn't like it, but they did. But we worked things out and they all left that room. We sat in that room for about 4 hours that afternoon and worked things through, talked things through. And then we had regular meetings with this same group that also expanded it in a much bigger way. And again, the communication part. Sorry to ramble on, but I wanted to kind of make that point because it was something that meant a lot to me and really kind of taught me a lesson here. The integration governance example, you talk about the international bank, you talk about, the executive steering committee and the integration change office, and we'll talk about more, but I wanted to give you an idea here about the kind of setup that we need to put in place. And Bruce talked about it. Here, there's a little bit more elaborate, but it's the same principle that you have to have it. And people have got to be clearly understand what they're doing, why they're doing it, and how it's going to impact the bank. You go back to my very first slide and how big the bank is and how broad it is. And again, these are the people pulling it all together in such a critical way. All right, next slide. Here's the examination, the example of an integration role and responsibility. The country head, the person that's going to lead here right now, is going to be and has to be the face of the acquiring bank to new customers and new staff. He runs the bank through the duration of the integration and the transition. But the big part of what I think he did and has to do, and this comes back to what Bruce is talking about in relationships and communication, builds relationships with senior executives, both at the acquired bank and the new entity. He builds a relationship with the board of directors of both banks. He has a relationship and builds a relationship with the superintendent of banks, with the Ministry of Finance, with the central bank. He has to kind of make connection. And Bruce used to do this extremely well any place you've been that I know. The top executives of other banks and really get to know them and be a key member like CAB, like Wendy has here in the Regional Bankers Association. The auditors and legal staff of the both the acquired bank and the new entity. You have to get them in and understand and use them as consultants in a way that say, "Kind of help me out. I need you, and let's see what we're going to do." And proposes overall structure of the new entity to the acquiring bank's executive, and identifies key issues, short and medium term, and leads the development of the strategies to address them as we're going forward. This is just part, and I'll go to the next slide. Again, this is continuation example of the integration roles and responsibilities. Integration and change office lead integration leader. This is such a key function in any major integration here. He's responsible for the overall integration of the new entity, works with senior executive of both the acquiring and the acquired bank, works with senior executive of the acquiring bank to define strategic direction for the new entity, builds and maintains strategic relationships with the new entity and the acquiring bank, and provides updates to executive steering committee on a monthly basis or as needed. Now, I know I'm saying this, and some of the banks, some of the integrations that I've been involved with are big operations. When you look at Peru, we have close to 300 branches and 11,000 people. And then like in Dominican Republic, close to 2,500 people now. But the same things apply, and maybe some of the roles can be combined, but you can use this as a guideline in terms of how to go about it and things, like making sure nothing is overlooked, nothing's forgotten. The next slide, please. Here is, again, site-specific areas of integration. This is the change office again. Introduces and maintains product management and methodology. Works with integration managers to remove roadblocks and define solutions. And this is so key. And ensures communication is maintained across all integration teams. Again, continuation. Our next slide. Integration managers here are selected from the local talent to head up and focus areas of integration. You know, for large and demanding areas, like I talked about, a local project manager might be assigned, but collaborates across areas via weekly integration management meetings and maintains clear and open communication. Your class, Wendy, will see communication coming on. Bruce raised it in a very big way. I am too. So important, and it's unbelievable if it's not handled right, how things can go wrong. Next slide, please. The acquiring bank, an example of integration roles and responsibility. Transition manager, again, acquiring bank representative who provides strategic and supportive link between the new entity and head office, aids in the development of strategic plans, identifies high potential employees for the ICO to review, which is so important, and level of involvement with their assigned department areas. Next slide, please. Integration best practices, and this is from my perspective. Maintaining focus on running the business during integration is critical. Bruce talked about that, did it, and I've talked about it as well, and I can't overemphasize it. Dedicated integration teams, whether it's the integration leader, the ICO officers, integration managers. Ideally, they're long-term experienced people who know Scotiabank, know the ways that you want things done, have been involved with other due diligences or integrations. The project decisions here define high-speed credit strategy early, high-level strategy early. This is so critically important because, again, you want people getting off on the right track. You announce your first and second line management upon closing of the deal and those of the balance of the organization as soon as practical. And yes, there's some casualties that you're going to have. And I think of another integration that I had in Chile as an example. I shouldn't have mentioned Chile, but just Chile as an example. And you're going to find this, it's going to happen in a lot of different areas too, that you might get people for whatever reason that they weren't picked maybe for the particular assignment that they thought they deserved, or they just didn't want the integration, or they didn't want the banks to be merged. There might be 10 different, 50 different reasons why they were bitter towards the bank. And this happens, and it's happened in almost every integration that I've been involved with, one way or the other. It's one or two or three people that you have to deal with and try and mentor, try and coach, try and manage them and try and explain the situation, get them on side and build them as part of the team. But in the end, if they're not team players, and as senior as they might be, and as knowledgeable as might be, if they're not a team player, they don't stay. And you give them that kind of ultimatum. You're part of the team or you're out the door. And it's happened, and it's happened in a big way. Integration best practices, as close as possible to deal signing, conduct a kickoff meeting with executives and acquired bank. And this is the first time they've all come together in this kickoff meeting. And I remember everyone that we've ever done and every integration we've done, it's really it's a full day event, and everybody gets a chance to speak and talking about what they're doing specifically and how they're integrating with other areas, how they're collaborating with other areas. And it really is an amazing thing. And people go into there just so pumped up and raring to go. And again, as part of the team is so critical. Begin the strategic planning process for the integration. And as soon as possible, after the close, and Bruce talked about the close, you plan and execute the post-acquisition review. And what I mean by this, you've done it, you've gone so far, you've completed the due diligence, you've seen what exactly has been recommended. Now they put it into action, you've got some of a plan. How did things go? What did they do right? What did they do wrong? How did the whole thing kind of pull together here? And this is what you want to see and what you want to do. And this post-acquisition review is very important. And again, we'll set up what the next integration. Every time you do one, you'll learn something new about it. And again, never is anything the same at times. I mean, everything changes, and you got to be prepared for the what if. And this is such an important part of being flexible, dealing with ambiguity, and dealing with some difficult situations. And assign here SWAT teams to quickly conduct assessments and define high-level strategy of the integration. Next slide, please. Here, communicate, communicate, communicate. And again, Bruce talked a lot about this. I have talked a lot about it, but there's nothing that's more important to ensure. And that means listening to, consulting with the people. I always say that the best consultants in the whole bank, and when you do an integration, are the people that have done the job. They know what works, they know what doesn't work, they know how to make things better. So when we consult with them, our own people, it makes a very big difference. But we engage in the leadership of both organizations. We facilitate employee buy-in to the vision. This is so important. Meet external stakeholders, customers, media, government, opinion leaders, board of directors. The board plays a big role, and Bruce is involved with a number of different boards, but they can play such a key role for you because they're always, in most cases, very well connected. They understand what's going on. They hear what's going on. They can share that back with you. So you gotta bring all these people together to see what you could do. So the comprehensive integrated communication strategy, again, frequent ongoing communication with employees, again, separate stream of management communication, again, and there it goes. So challenges and success factors for key lessons learned. Here, I'll go to the next slide. Alignment amongst and between integration teams, that's so critical. Integration and change office, it plays a critical role. And again, being so close to them. Executive and all levels of employees of both the acquiring and acquired bank, maintaining focus on what's important, volume of work, maintenance of scope, matching the right resources to tasks, identifying all project linkages, meeting regulatory requirements, key employee retention, customer retention, minimize customer impact and confusion. You see the little guy, that's Peter Castanis, I think, was scratching his head, if I remember correctly. Our next one, critical success factors, consider. Here again, clear, constant communications, standard methodology, the effective training, the executive support, buy-in, keep them well informed. And again, I know this is different in every place. And I think Wendy with CAB, I mean, you're going to have a lot of smaller banks, medium-sized bank, and larger banks. So, but what I've tried to outline here is a kind of one-time. It doesn't fit all, but again, you can take parts of it and use that as a means of communicating and means of sharing. But quickly select and announce senior management appointments. That's a key point. Open and ready for changes. Again, dealing with ambiguity. Leadership, adaptable and flexible. So very important. Able to lead teams through uncertainty and maintain morale. And here are key learning points to reinforce, communicate clearly, be respectful and aware of the culture within acquired bank, and listen to your key people, to the people doing the jobs. Leverage strength on both institutions. Create a strong sense of local accountability and ownership. Engage people, and they'll be motivated to do so much more for you. Modest and strategic use of head office resources. Consistent processes used in all transactions. Keep it simple. Significant planning and effort pre-close. Reinforce the importance of cultural integration. Customer at the center of every decision. Plan accordingly to minimize customer impact. And Wendy, that's it. Thank you very much.
And I think that has been so Jim, sorry. So I thank you. I think you actually built on what Bruce originally said in a lot of those instances.
Yes.
So you kind of took a really macro approach to looking at this, and we have the benefit now of being in a situation where we are leading through perhaps one of the most historical acquisitions from an Indigenous bank perspective. And that is where a consortium of small banks across the region have come together to make the acquisition of the Royal Bank of Canada Holdings purchase. And so we have Dalton Lee, who would have been one of those visionary leaders who sat in and brought this all to fruition. So Dalton, again, thank you so much for joining us this afternoon. And for this segment, perhaps what we will do is have something of a candid conversation. Let's see if we can integrate some of the points that were made earlier by Jim and Bruce, and see how it applies to the real life situation as it's unfolding today. So welcome again, Dalton. And like everything else, this is the real world. This is what we're adjusting to. Dalton, you're on mute. If we don't do that,
all right. I need to unmute. Yes, I need to unmute. So there we go.
There you go.
I hope everyone can clearly. Good afternoon, and thank you for having me and putting this panel together. What I hope will be a very robust discussion topic, as it seems to be throughout the region like fire. Unfortunately, or fortunately, I am not as well organized as other two panelists, with fancy power and things of that nature. But I'll attempt to do this afternoon, speak in I guess as candid as possible, and I'll try to change the names to protect the innocent. Not that there are many innocent, but or that there were many innocents from us. I will try to be as candid as possible. And I will first start off by saying that everything the two previous panels touched, highlighted, are spot on. Effective of the overall planning, diligence, the transition, the closing, integration, and all of those things are really, just those are the required to get you through. I haven't been one of 5 of the indigenous banks that put in the RBC acquisition. What I would like a little bit about is just how in that, the successes, some of the challenges, and any kind of takeaways that I could share with the this afternoon that would help them as they go through, if they're planning on doing it or if they're now.
Absolutely.
I would say, just from I was perspective at the experience overall was a good one. As Wendy alluded to in her introduction of me a few moments ago, we were consortium banks, indigenous banks in the Eastern Caribbean, who were for the first time going out in an endeavor where we would actively try to accomplish something for the benefit of all of our customers throughout and the footprint. As you know, with any, if you have more than one person in the room, you ask a question, you are asked to get 3 different opinions. Well, we had 5, and these all very strong-willed, opinionated individuals, and so just kind of get a decision. In some instances, challenging, but we were able to go through that, and we were able to come to consensus in a lot of instances. I think most people wouldn't have that type of experience, but I will say a couple of things, very broad, in that I cannot overemphasize, both Jim and Bruce did, the need for communication. It is, I think, obviously you're going to have the technical aspect of this, where you've retained, an advisor, preferably one of the big 3 or 4 consulting firms, international consulting firms, and then you're going to remain a mergers and acquisition legal team. separate and apart from the normal day-to-day local legal reputation that you have, because the transactions of this nature require individuals have done this enough times. But I will say, commissions to, again, your customers, your staff, your regulators, your government, and think even more important than some of the others I've mentioned, if you have a union environment, the union, because I'm sure one on this call is well aware of the trials and tribulations of one of my fellow consortium members and what they've gone through over the last 2 months with a union in one territories where we acquired banking operations of Royal Bank. And I think that it is paramount that as you're going the negotiations, you try your best to get permission from the bank being acquired to initiate communications with all stakeholders as in the process as possible. Because I think that is going to be a key in many instances to the successful rollout and integration and operations post-integration of the bank. The other thing that I would say is regards, and I think it speaks to what Jim said, was to the best of your ability, try to have a team that has limited data responsibilities. This particular project, this acquisition, sale, or depending on which side that you're on, is a full-time job. It's a full-time job. I, as chairman of Bank of Montserrat, was charged with leading the negotiations on behalf of the bank, primarily because we were in transit we will lose our CEO was retiring, our deputy had decided to go to greener pastures, and so I was asked to fill in to that void, and it was a full-time job. It was, it really is time-consuming, the amount of decisions that have to be, and that's the other thing I think that probably both Bruce and Jim mentioned, is that you have to have someone at the table or involved or leading the transaction that can make decisions at the table or close to the table as possible. Because if you have to have one that's got to, stop, call, and, then call the other person and, all that, that's is just bogged down, and the, to assure you that the hourly rate of your lawyers and your advisors are not going to be $50 an hour. So the less time you could spend with them, the better off you be. Try take the opportunity, also would say, to review your processes. Make the assumption that you're the acquiring bank, kind of sort of the situation, a little bit of the situation I spoke of with we're acquiring the jobs, we know what we're doing, they probably don't. Take the opportunity to review all of your processes, and there may be process and systems that the bank that you are acquiring in place that are better and better suited for the combined bank end of this process requests than what you currently have. So don't be so, pull in your view to think, we know it all, we know it best. But it'll be difficult because, there's going to be this option within your organization, if you're the acquirer, that, well, we're acquiring them, and there's a reason why we're acquiring them, because we're better than them, and that is a mindset that you work very, very gently to mitigate, because it's going to be, it doesn't provide the opportunity for improvement, overall improvement of your operations. That action like this would provide. The thing that Jim spoke also, and I can simply reiterate, is that I go through a transaction like this. I think saying that comes to mind, or that came to mind, I looked around the bank, is that is rises to the top. So this in instances, this is the time most of these individuals in your organization will be exposed to action of this nature, and to learn to become in the transaction, learn and to grow, and to be curious enough to ask questions, and to be intent enough to process the tons and tons of data that you're going to get in a transaction. That is very, very critical, and you will see high potential employees are, and those who are not up for the challenge. And I think don't turn a blind eye at, because I think post integration, what you're going to find is that the individuals that were performing at the top of their game during the due diligence and the transition are the ones that post-close will be your rising stars. And then finally, as you do this, there will be a number of speed bumps. It's going to be bumps. But I maintain that as long as you're committed to the end, that you'll be able to find a way to get there. So whoever is leading that integration team, whoever is leading that negotiation team, whoever is leading your transition team, they have to be fully committed to the goal that the board and executive management has agreed to. Because if there's any doubt, they will see every speed bump as an opportunity for it's not going to work, and I knew it's not going to work. This is why it's not going to work. And so you have to have someone leading the operation that will, you will all be of one accord, so to speak. Because other than that, you're going to find yourself in a situation where you're constantly having to, to provide more guidance and answer the questions and up with the solutions, where are the inevitable speed in the process, because there will be speed bumps in the process, and we have to be prepared for that as we go through all of the stages of the transaction. I said final. This is really my final. The thing I would say is that you should never lose sight of whatever value is that you saw in the transaction. Because, when you get down into the weeds, sometimes Jim mentioned, and he was talking about the portfolio and, you know, the condition, and, you know, that can be a little bit disheartening to, you know, to your credit team or to your lending. But I think if you have a good enough understanding of the fundamentals of that you're acquiring or the that you're acquiring, then, you know, you don't want to lose sight of it. And, you know, if you're going through the negotiation and you are, you know, you hit a bump, it is important that you still have that resolute mindset. You say, you know, there's a reason we're at the table, and and that reason is the overall value we saw that brought us to the table. And sometimes it's hard because you're going through the process and you are thinking, well, overall, this deal is going to cost me. And then as you go through, you may find out, well, it's going to cost you X plus because now there's this we found or something that they found. And you're like, well, it's more than, you know, X that I thought I was going to have to spend. And, you know, it's very, very important that you just keep in mind that in 5 years, I won't even go to 10, 5 years, our deal is closed and you look back. A lot of those things that you thought was so important at the negotiation table, won't even remember them. You know, I've just like Jim and Bruce, in addition to this transaction, above transactions in my corporate career, and you know, you move the further you move from the close, the less important some of those big things that you thought you could never count becomes. So that's if I was to have any kind of advice as you go through that negotiation process, one of the things that I would say. And you know, I think overall, you know, as I've just indicated, in about 5 years, I think the first that bought the 8 banking operations throughout the Eastern Caribbean will look back and say, you know, yes, it was painful as we were going through it, but in the end, it was well, because we're now all of us in a strong place from a financial perspective, from the ability to serve our customers, from the ability to help development of our country overall. And so I think when it checks all of the boxes that why banks are in business. You know, we're here to be a stabilizing force from a financial perspective, help our customers to be on stronger financial footing, and also to obviously to provide a good return to our shareholders, and at the same time to our countries and the communities in which we serve to develop to the best of their capability. And with that, I'll stop. I probably went, 20 of my time.
Absolutely not. Dalton, thank you so very much. You certainly were extremely well prepared for one who thought that he wasn't. You've taken us through and given us quite a framework in terms of the experience of the Indigenous Consortium that came together for the acquisition. I have jotted down quite a number of questions as I listened very intently to all three of you gentlemen. Thank you so much. I'm not sure if everyone on the call, I know two of you on the panel know each other, but Dalton, you fitted right in there. I think at some point the question was asked whether or not he's a Scotia banker. He sounds like he's been in there with us. So let me jump into the questions that we have from our listening and viewing audience. Thank you again to everyone who made the time to be on with us today. And maybe we can do it like this. Because we do have you on, Perhaps I can open the floor and ask Earl Gill to ask the question that he posed for Dalton to kick us off. Earl, do you mind? I'm putting you on the spot a little bit.
Me?
Just for you, Dalton. This one is just for you. So Earl, go
Hi,
ahead.
Dalton.
I'm having problems, but go ahead.
You can hear me?
Go ahead.
Okay, Dalton. I think it's
I
the
can
first time we've sort of met. So hi. I guess the question that I wanted to raise was, do you foresee any opportunities to create economies of scale to optimize your sales and operations through some sort of shared services functions, which ultimately could or should improve your customer experience and create standards of excellence and improve profitability?
That's a fully loaded question, Dalton. I'm not sure if you got all of that.
Could you repeat it? Because like I said, the audio was going. If you repeat it.
Certainly.
I heard something about synergies and operating efficiency.
Out is given the acquisition that is currently in train or has just been signed off on and completed, do you recognize any opportunities for shared services and investments to assist in ensuring a profitable outcome for yourself and your members, as well as from a credit risk perspective? Earl, I hope that I've represented you well in summarizing that.
Yes, you certainly have, Randy.
I see the question now. So I
okay, great.
So this question is for all. Do you have opportunities to create economics and sales application shared services? Yes. I think that's a very good question, and yes, we do. I will not be out of school if I said that the 5 members of the team, this as the first step in, or hopefully would be many more opportunities, those types of services, functions, and centers of excellence, as some call them, because clearly, especially having this particular trend with Royal, and they are a world-class banking organization, and they had that they've throughout the region that had, in essence, services centers in their operations. You from that process, and so I think they recognized that the way forward to continued property across all of them, especially this. We've seen this on the shrink in the margins on your lending, your deposits, that to come up with other can't raise discriminately regardless of who you are, and we see a shared services model, the model to sustain efficiency in providing service to our customers and providing additional to our shareholders. Because if you just one example, and then one example, if you were to take the AMLT, the compliance function of the bank, of each of our banks, we each, and bank, not well, we each have one, banks have one, and that's however many, 8, 10, 12, that, and as a leg in this to try to combat the risking thing, having a centralized ML CFT function that is of sufficient scope and rigor, you know, the current banks will look and say, okay, I got one place. I know exactly how rigorous the process is. They'll say, well, and the area of scale also in that place. And so I think it's a lot more attractive to them. You say, okay, yes, you know, Bank of Montserrat on its own to, you know, Bank of Nevis on not be able to, but Bank of Montserrat, Bank of Nevis, National Bank, ACB, you know, and on, and you get enough, and the process is sufficient robust that then, you know, the risk has been decreased considerably. But we do see that as.
Okay, so I do recognize that we're having some challenges with Dalton's bandwidth, but I suppose in short, what Dalton is saying is recognizing as we're going through the process, there is definite and distinct opportunities, to your point, to determine whether or not we can look towards expertise in the field so that we can establish the shared operation systems as are being discussed. I think it's certainly timely to say that it is one of the things that we know, for example, the governors, the Eastern Caribbean Central Bank is looking at establishing. And I think the timing could not be any better than it is now. So Dalton, we will come back to you and hopefully we will be able to get through, because I think this is certainly one of those areas that we want to continue to explore in terms of what is happening as we speak and the possible impacts if we are to really get our arms around it. So I will go back to the questions. Robert Frederick is on with us this afternoon. So I affectionately know Robert Frederick as Bobby, as I'm sure many do. So Bobby, why don't I head on over to you? I know you have a question for the panel, which perhaps is related, but go ahead. I will open the mic to you if you're so inclined to speak. Otherwise, I'll be happy to read out your question.
Are you hearing me?
Very clearly, thank you.
Okay, thank you very much for the opportunity, Wendy. I've actually posed a few questions, and perhaps I should start with the first. And this goes to all the panelists. Given the size and relatively small scale, and indeed the limited resources of many of the regional indigenous banks, and the absence of full-fledged mergers and acquisitions departments, what might be the main risks or drawbacks to outsourcing due diligence and other planning activities to consultancy firms by regional banks contemplating future acquisitions? I know it's a loaded question.
Yeah. Anyways, let me jump in on that. And it actually is similar to, I noticed in the chat section, Ian D'Souza of Republic Bank made a similar kind of comment or question. You know, for the indigenous banks, certainly I believe we got to focus on what are the key issues. I mean, the process that Jim talked about when Scotia's buying an operation in Peru or Chile, these are very complex operations, and not that the indigenous banks are not, but the degree of complexity can be different. You know, in staying focused on those few things that are important, where are the biggest risks? And as with any consulting relationship, is managing that relationship and where you want to see people, you know, see your advisors focused. But I believe that the institution, the inquiring institution, or in the case of a true merger, the leadership of both institutions, I think, as all of us said, communication is one of the top 2 or 3 things we need to be focused on. And it's important that the executive of the acquiring institution, regardless of what consultants or advisors are retained, the communication needs to start there. And there needs to be a clear idea, as Dalton said, of what are those 2 or 3 or 4 key reasons for the transaction, and making sure that that's being communicated across the employee, the team members across both institutions, and to the advisors as well. So for Indigenous institutions, stay focused on some of the key things. Keep your advisors focused on those key things. I mean, my business at Bantac, we do processing, but we do some advisory work as well. We need to stay focused when we are in an advisory role on what the institution who's engaging us wants us to stay focused on, and make sure that your team just communicated to your team so they know what they need to be doing. So the principles I don't think change. It's just when you don't have a huge team behind you that an international bank that Jim and I had when we were with Scotia, you got to know what are those 3 or 4 things that you need to get right, and make sure that you keep all your people focused on those few things.
Great, thank you, Bruce. I believe I did see a question in there for Jim from Bobby again. Could you explain what kind of training takes place in the transition phase, and what groups are likely to be targeted for such training, sales, service, or back office functions? And Jim, that's for you. And that's our little test. Ding, ding, ding. Jim, we need to unmute you. Technology has us. Sorry, you're still muted, Jim.
Sorry, thank you.
There you go, no worries.
Okay, so back to Bobby's question in terms of the training through the transition, what type of training? Again, what we've done, and as Bruce had mentioned, and I'm looking at the bigger ones, but it really can apply, that what we've done, when you take the integration managers involved in each of the specific areas, we're looking at those ones, whatever the integration managers have done in their experience in the past, we try and relate to what's going through the person's mind, what's going through the actual training right now, and then make sure they're matched together. But it's actually kind of taken over the function that you're on the job training to the largest extent that we have. I'm not sure if that answers your question or makes it more confusing.
Bobby, that was a question for you. So are we good?
We're good.
Perfect, perfect. All right, great. I know that Dalton is still on with us, but I think to manage bandwidth, we would not likely see his representation, or maybe we will.
No, I came back on.
Okay, great.
Need me, I'll show up when you.
Okay, all right, perfect. So Dalton, I actually have a question for you, and I think you kind of alluded to it earlier in your presentation. You had a very peculiar circumstance where you managed through the pandemic, this acquisition. And then, of course, like you mentioned, one of the members was hit with union action. And then, of course, we had a volcanic eruption in St. Vincent, right? And then we heard from the gentleman before on communication and keeping the team engaged. I mean, you were really throwing curveballs from every direction. How did you all keep it together and continue the operations from a customer standpoint?
Well, I think what the biggest impact to the transaction that COVID had for us was in the time, because I think one of the things that it could, well, there's a couple now that I'm thinking about it. The biggest ones is the timing. What happened was, is it hit a lot of institutions and organizations started working out and staffs and, from home, and, there were and there were obviously there's still travel bans in place. And so the meetings that you would do, face the ability to go, you were acquiring a operation on an island you didn't reside on, and they go on to that island and as we would say, and look on, did not occur. So you can be agile enough or to kind of the best and be quick enough to do that you would go out and you would tell someone on the ground that you can trust to on your behalf and put back on a regular basis. So that is the effect. The response, I think, is that we had to be in constant communication with our staff and with both our existing prospective customers. Every time we had change the date that we were going to, and the transaction, that was going to begin. So there was that. You in needing the deal and putting the actual event together. Here again, having competent outside counsel and advisors, because you want to have the contingencies built so that, as an example, you have, and the value of buying decreases, then you should have opportunity to pay less. Likewise, if the value increases due to some other macroeconomic condition, then you would pay more. So you have to be mindful of that documented. And I know, I think everyone on this class today will be familiar with enforcement. And I think that is something that you have very, very, very about what within that as well. Because, in the St. Vincent's, you've got, no one, well, we are Canic Islands more or less. I don't think anyone anticipated that, be option at closing. So I think that's how it impacted. That's how we reacted. Those are that's the advice to anyone who is himself in a similar situation.
Okay, thank you for that, Dalton. I noticed that we have a question from Dawn Happel. Dawn, would you like to ask that question live to the panel?
I think his question asked that you read it out, because he said he's on mobile.
Okay, so, oh yeah, I see that now. Okay, so how do you ensure solid planning occurs? And this is to the general panel. Have you overcome resistance to the planning phase? That is, many organizations are focused on agile processes, usually translated as less paper, more doing. And would anybody like to take a crack at this one? How do you ensure solid planning occurs?
Well, from my perspective, I'll give it a go, Wendy. I mean, the planning is so critical to the success of any of it. This is so important. It's ingrained into all of the people, like the integration head, the ICO head. I mean, these are the things. And what we do on a weekly basis is, again, we have the building blocks process that we use. Everything was supposed to be done is outlined exactly what has to be done, and then how they have to do it in the whole process. And then they've got to explain to the overall committee on a weekly basis what they've done, how they've done it, and ensure that it does fall into place and that it is collaborating with all the other areas that might be impacted from it. But there's an accountability that they have to do it to make sure it's done. It's more the activity and more the actual end result that we're looking for. And again, that whole planning process will ensure that that end result is there. If it doesn't work, then they're in trouble.
Okay. Okay.
I mean, from my perspective on that, and I'm not sure if I'm answering the question specifically, but the planning, like for the effective planning, key to me is the communication between three different groups, whoever, and if it's in a smaller institution, it might be 2, 3, 4 people that are in charge of leading an integration. The leadership team and the people doing the day-to-day in the acquiring institution, the people doing the day-to-day in the target institution, and during that transition phase between legal or between the signing and the closing is communication. There just needs to be a lot of communication of what's the desired state and working that through. And if there's one thing I think through 2020, we've all gotten much better at making things happen and developing plans without sitting in the same room together. So I think today that ability to put together a plan on a kind of agile basis without a lot of paper is something that we're all much more comfortable with. But it comes down to whether agile or not, the level of communication between transition team, acquiring institution, and target institution. Put smart people on the team, and you can develop the plan.
Okay. I'm certainly hopeful that that answers the question as it came through. Let's go again. Let's see, Dalton, let's see if we can push through with you just one more question, and hopefully we will have some clear audio. And this is really for the panel, but more specifically, Dalton, you may want to jump in on this one. We've seen a number of failed attempted mergers recently. Specifically, we would have seen quite a bit of media related to the possible acquisition of CIBC. And then we saw the offloading of Scotiabank in Antigua, for example. What do you think is the knock-on effect from a customer and staff perspective when mergers fail or when attempted mergers do not go through, as compared to what you would have gone through in this instance?
So if you have the question correctly, and I'll repeat it so that for the sake of making sure I got it, is
Sure.
You're saying we have a number of instances where merge not got timeline as, once after it's done, the question is, how do these FAMPs impact the employees of the entity that is acquired, and how you kind of, manage that? Is that the question? You're muted when.
Yep, definitely.
Okay, so I think that the sense of limbo and run the risk, very genuine risk of you run a very genuine flight of your top, because one wants to be in that uncertainty. I think that the comparable situation for us was having to move, anticipated that we would have closed this transaction 2020, when closing at the action 2021. So, the thing that community staff would be documented by a certain, we missed though. But again, what the best solution to a situation is to be in constant communication, be brutally honest. I think it would you through that in deal with your talent and your employees, But the long-term impact, like I said earlier, is really negligible, but working is going to be very, very tough. And you have to spend, you have to be committed to have those conversations, because they're not easy to have. You're not going to have the time to have them. You're going to have to make the time to, and to be as forthright with employees as possible. Ensure that, and listen to them, because they have concerns are very valid, and so you have to listen to them and provide clear answers. And when that changes, if it does, you got to go back to them and say, well, here's what changed, here's why it's not, we didn't have to do with it, or whoever is responsible for it. Communication here, I think, is key.
Yeah, I mean, if I can add something of the transactions you talked about, and I think it's important recognizing that some of them were regulatory issues, and we can never predict exactly what a regulator is going to do. And with the greatest communication and relationships with regulators, again, you never know what they're going to do. In some of the other examples, I think it highlights the importance of communications with other stakeholders. The example was given of unions, as with the example in Antigua, with governments, and making sure that a lot of stakeholders have competing interests, and it's not easy, and sometimes it's not possible, but that's where that communication with all those stakeholders is important. And as Dalton said, with your employees, that's why, I had always, even not to do with a merger or an acquisition, but just through all the change going on in an organization, at any point in time, knowing who are those absolute key employees that I need to make sure I'm talking to, so that if they have concerns, we know about it, and who are those key clients that we need to be talking to all the time, because let's face it, there's not every employee and not every customer. If we lose them, it's the end of the world, but we all have key people and key clients that are critical that we stay close to, and as leaders, that's our job, to stay close to those key relationships.
Absolutely. Thank you for that, Dalton and Bruce. There's just one more question, and then I think we will move to wrapping up. And this is, again, going back to communication. And I think, as we have positioned all of these discussions this afternoon, it certainly leaves no small wonder in terms of what is perhaps the greatest opportunity to successful implementation post-acquisition, and that is communication. So the question here is, when to stop communicating change? What about training for post-merger roles and responsibilities, and when to start communicating on this, right? So again, it goes back to...
What's your question? The post what? Sorry.
What about training for post-merger roles and responsibilities? And I know that you also spoke, Jim, about recognizing the talent pool, recognizing your top talent and the persons that you actually want to stay with the organization, and perhaps you have a vision for them. So when do you begin that communication, and when do you begin training for post-merger roles, noting that there will be change?
From my perspective and my own experience, comes right in the whole transition period. So you got the very first period was the due diligence. After the deal is signed, and right after, you know what you're going, then you move towards that at that particular time. And you kind of stay with it until the people are ready to take on and assume the responsibilities for the job that you're preparing them for and training for and planning for.
Excellent, thank you.
If I if I could, Wendy, I would say this, and I'll just keep my camera. Maybe that would be you'd hear. I say that the training for I've just gone through it. I would end strongly. Try to get training for both sets of employees on a specific your frontline employees during the well, what is defined as the phase, but it's really signing pre-close. So you've signed the agreement, you're going through, setting up your travel agreements and stuff like that. As you're going through that, what you don't want to have happen, and we've had, fortunately, an example of that thing happen, is come to close first day of training, and the people of the bank that you, for some reason, they're not showing up. And what are you going to do? And so you wait. I wouldn't recommend wait for that transition, but that you wait, try to do it, and you between signing and closing, so that you're prepared, somewhat prepared, in the event that everything that could go wrong on day one through, I think, like as one of my my associates experienced recently.
Thank you for sharing that, Dalton. I'm not sure if anyone else on the panel has any final comments, or I will give the opportunity as well to persons in the audience. This is your moment. Any questions or thoughts that you want to share with us this afternoon before we wrap up?
I'm looking at the questions in the chat, and I'm looking, communications. I think it was Mr. D'Souza was saying best communications of the premier van would have failed, but I think we were fortunate that we came out the Republic acquisition, and we came out that whole Antigua debacle. So we made conscious effort, and I think in working with the regulator and recognizing that we have to get vesting orders, ministers of finance in all of the territory which we were acquiring operate. We flew to meet with the ministers. If there's any of a hesitation, and you have the representation on island, you didn't think you have the support on, often someone else may come with, three of us may come with you. And so we tried to make sure that we pre-sold it to the ministers of finance and ministers of the territory, so that by the time they got to the monetary account and ultimately to sign vesting orders, they were versed, and we given us a nod and a wink and say we got to this transaction. If they had concerns, them as we would go through that process. I think again, it is the mission, I think, that can never be overemphasized as you try to, yeah.
Okay, great. Thank you, Dalton. I realize that there is one more question, Lisa. I do see your hand pop up there for a second, but we have a question from the audience. Shireen, would you like the opportunity to ask your question in person? No, I'll take that silence as a no. is there a possibility of the phases overlapping, where the transaction or integration phases occur at the same time? And if so, are there any best practices that you can offer for management of that sort of overlap? Jim, I think you're trying to go at that one and you're still on mute. Thank you. Yep,
Wendy,
there you go.
I
Great.
don't know why. From my perspective, there's always going to be some overlap in preparation for whatever you want to do. And that's good and that's healthy as far as I'm concerned. So I'm not sure, I mean, to have that overlap, there's nothing wrong. And I think it's almost a requirement from my perspective in what you're doing in terms of the, say, the due diligence process and then your transition process and your integration process. There's got to be some overlap in all cases, if that is answering the question.
Okay, so Shireen, give me a thumbs up if that met your expectation. And while we do that, Lisa, I know that your hand popped up for a second there.
Yes, one of the things that I wanted to ask of Jim, of Bruce, and of Dalton, in some other markets, our consultants have seen situations where the bank that's acquiring is actually not the bank necessarily that has the best processes or has the best people, or may not even have the best technology. They might have a lot of older technology and a technological debt there. From how can you really help ensure that you keep the best from both institutions? I can see that this could be a case in the Caribbean where the international banks may have all sorts of things that they're great at, but they may not actually know the customer and the needs on the individual islands as well. So gentlemen, would you have any comments on that?
Yeah, I mean, let me take a first shot at it. First of all, I'd say there's sometimes an assumption that the large bank has the best technology. I've seen plenty of instances where that's not the case. And yeah, but anyways, let me just leave that one there. You know, going into, again, every integration is going to be different, and it's going to be determining, you know, you're not always going to be able to keep every product out there because you got to choose one of the systems. I would expect that through the due diligence phase, there would be, if not decisions, a pretty clear indication of what the ramifications were going to be. Do I stick with my system? Do I go with the acquired institution system? You know, in the case of acquiring, as I'm sure many people on this call and in CAB would be aware, in the case of acquiring from a big international institution, you're not going to acquire their system, which creates challenges. But from a planning perspective, it's knowing all the way through due diligence and through your transition, what is practical, what's doable, and you know, what can I do on my system? How can I, because one thing as well, I'm sure we've all learned that there's a lot of things we can do as we manage banks, but our system defines a lot of, you know, that's the boundary. I mean, we can all change our core system, but that's a kind of once every 10, 20 year decision. And it's being very practical on what's realistic. And if there's a certain product or a certain service or something that my existing platform will not allow me to use, then I should build into my due diligence and the models that I'm modeling what's my revenue and profitability going to be out of it. Be very realistic and build that into it. You know, I'm a firm believer you cannot be all things to all people. And that includes a big international bank. Big international bank will never be as close to the customers as the indigenous bank is. And even when I was running Scotia Caribbean. And I think even at a CAB conference, I remember saying that. I can tell you all things we are great at as a big organization, but we will never be as in touch with the local market as an Indigenous institution. And how do you leverage that strength, even though you're not going to have as much money to put into systems and technology, and do your financial models based upon that? That's realistic, my view.
I agree with Bruce.
You're muted, Wendy.
That was my turn, folks. It happens to all of us. I was asking, thank you for that, Dalton. I was actually asking you, were there any final comments from you with that question?
For me, I agree. I think that there's this perception that the larger banks know the better technology, and in instances they do. But I would disagree with that from the point that in recent years, the banks, regardless of their size, have had to invest in the technology similar to the large multinational banks, just to comply with the MLT, B, a level of service customers that's at the level of they get down the street, and C, to internal efficiency in their organization so they can operate at a level that will continue to allow them to remember where the margins in your core business is getting smaller. And so, yes, that there was this perception that, the larger banks, the best technology. And I think in some ways on the periphery, that is what we found, in how, in the case of Royal Bank, systems that they had with how they read their documents and where they did that and that. But from core banking, we found that we had comparable systems. Yes, it was taxing to get them in, but if we didn't have it, I don't think that we would be competitive in the marketplace. And I think more and more we're seeing that the index, though they have the capacity, and in a lot of instances, suited against that, a better understanding of what's going on the ground, we all invested heavily in to ensure that we can provide the level of to our customers that have grown accustomed to on our islands internationally, because I think our competitors, from a logical perspective, are not the banks that are here, so the businesses that are in North America and in Europe, because to the extent that some sit in their and complete in transactions, purely and efficiently, also sets an expectation that went to their bank, and the bank will be able to provide them with the opportunity to do something similar. So the bar not only raised by international banks, but it's just by all of it of service that customers interact with day-to-day basis.
Okay, great. Well, I certainly want to take the opportunity to thank all of our panelists panelists, as well as our audience who sat in and sat through an hour and 45 minutes of discussion with us, which certainly speaks, and a very engaged hour and 45 minutes, I might add, which certainly speaks to the fact that this is a very critical topic for the region at this time. Of course, I get the sense from some of the questions that there are lots of speaking opportunities in terms of, really demystifying the process of an acquisition and what it means for the persons who continue to lead through the change. Certainly, as the ink dries in these sorts of transactions is when we really hit the ground and begin to discover and perhaps unearth some of those things that we may have missed in our planning processes. And so discussions of this nature are really critical at this time. Certainly, it's something to look out for as we continue to work towards our CEO and Director Forum for the month of June. And we will hopefully have persons who were intimately involved, like Dalton was, sitting down at a round table to discuss and hash out a little bit more about the Caribbean experience with merger and acquisition of this nature. So to all, I want to say a special thank you. I will ask you to stay on as we look at an advertisement from one of our sponsors this afternoon, Salesforce, who came on board to support this, recognizing the importance of the conversation and, more importantly, the critical role that they can also play in ensuring that it is a smooth and soft landing from a technology and integration side. So Terry.
Salesforce is the world's #1 customer relationship management CRM platform. They help your marketing, sales, commerce, service, and IT teams work as one from anywhere, so you can keep your customers happy everywhere. Salesforce unites your marketing, sales, commerce, service, and IT teams from anywhere with Customer 360, an integrated CRM platform that powers the entire suite of connected apps. With Customer 360, you can focus your employees on what's important right now, stabilizing your business, reopening, and getting back to delivering exceptional customer experiences. Okay. And of course, we'll be sharing that to you subsequently. So we will certainly be able to give you a lot more information about Salesforce and how they can assist in transforming your business. We are just going to get our next panelists on. We already have Mr. Thomas O'Rourke from the Bermuda Bankers Association. He's on already. And we are just awaiting two of our participants from Australia, those being Dr. Louis De Coker as well as Gavin Coles. So they should be coming on shortly so that we can proceed with our next round of conversation, our next bit of dialogue, which is developing a correspondent banking playbook. And Lisa will be assisting in taking us through the next section as well. That's Lisa Skinner from Digital Financial, to whom we were introduced earlier this afternoon. And whilst we await the other two gentlemen, I think Lisa is on. So Lisa, do you have anything to add?
Well, I can do a little bit of rah for Gavin and Louis, who are yet to come on, and they are associates with Digital Financial. We are a small consultancy that is very specifically focused on helping financial institutions and regulators navigate the world of digital. And Gavin, in particular, has a great deal of experience with the issues of correspondent banking. He has a large history, both with government and financial crimes units, with correspondent banks themselves, and with major international banks from all sides of this discussion. And joining him will be Dr. Louis De Coker, who is actually well known for his work on KFC, AML, the appropriateness of the level of expectations of compliance based on the level of risk in institutions. Dr. De Coker is an advisor with CGAP and World Bank on exactly these issues. So I'm just going to give a few more moments and give the gentlemen a chance to come on. They are joining us from Australia. And so the fact that we're about 5 minutes earlier than they were expecting is 5 minutes less of sleep. So they'll be with us shortly.
Up here in Bermuda, and what I'm going to relate to you today is our experience with correspondent banking and the de-risking initiatives that swept through the U.S. That led to some decisions to try to limit that service here that we experience. So I will relate more of that, but I see now my colleagues, Gavin has popped up there, so I will yield the floor and come back later.
Great, thank you. And I thought I just saw Gavin in here.
Yes, he's coming right back on.
Perfect.
Good morning, it's Gavin here in Australia. Can you hear me?
Good morning, Gavin.
Let me just turn this down a bit so you don't get any feedback. Wonderful. Okay, we're ready.
We're just waiting for Louis, Gavin. He said he's sent us a WhatsApp and said he's got some network issues and should be on shortly.
Wonderful. Morning, Tom.
Good morning or afternoon, depending where you're at.
You can see out my window, it's a little bit dark here.
And may I just ask who is driving the slides? Is it Regine? Is it Terry, or is it myself?
I'll do that.
Okay, perfect. Just a few
It is strange how every time I do a presentation or Zoom meeting, the camera angles are slightly different for every system. So I set it up very carefully so you couldn't see my window, but it's there. Yeah. So it's yeah.
Well, this you see Dawn in Australia.
That's true. That's true. You can see I'm not in a studio in Hollywood. I think Louis sent an email that he's still having a challenge with the link. Maybe we could resend the link to him.
I have just received the link again, so with any luck, Dr. DeCoker has also. Gavin, would you feel comfortable starting if if Dr. DeCoker gets really tied up here on this?
I think so. I think we're quite flexible, and I know that Tom and I are speaking first, so I think that gives us some time, and it means the delegates aren't waiting too long. Okay. Everyone should be able to see Wendy's screen with the presentation. Is that correct?
I certainly can.
Wonderful. Okay, I think what we'll do, Tom and Lisa and Wendy, I think we'll make a start because it's 6:03 in the morning here. So I think it's 4:03 in the Caribbean. And Tom, I'm not sure which time zone you're in. I think you're probably Eastern Coast, so around the same time.
5:03 here for me.
503, fantastic. Okay. So good morning, good evening, good afternoon to everybody around the world. Very good to be here today. We're here to talk about correspondent banking relationships again. Some of you joined us in a discussion a few weeks ago, which was very productive. And we're talking today about some of the ways in which financial institutions can handle this issue of correspondent banking relationships, how to build them, how not to lose them, how to improve them, and how to get themselves into a safe space, as it were. We have three speakers today, myself, Louis DeCoca and Tom O'Rourke. We're all very experienced. You can see our backgrounds in the slide, very experienced with correspondent banking and financial crime matters across a range of areas. We don't have too much time today, so I'm going to just talk through at a high level the agenda we're going to cover before handing on to Tom, who will give us an update on the current situation in your region and some of the recent events that we've seen. We'll then talk about some of the global risk drivers at the larger correspondent banks and how they make decisions. And I've worked with a number of correspondent banks and international banks around this issue of how they select, they keep, and they eject correspondent banking relationships. Some of the issues that we have in the understandings of your region, because every region around the world is different, and sometimes that isn't always fully understood by some of the larger organizations. Louis will talk about some of the new challenges and new opportunities we see in your region as well. And then we'll talk about some of the methods of building your playbook. So as you think about these relationships you have, how you can keep them and strengthen them and be less at risk of losing them. So without further ado, I will hand on to Tom to talk us through some of the current issues in the region. Tom.
Thank you, and good day to everyone, and try to make my remarks as helpful as possible, and if I lose anybody, please raise your hand and let me know. We up here in Bermuda, we have 4 banks and roughly $25 billion in assets. We are pegged to the US dollar. We clear, all of our clearing is through US, large US banks into US dollars, and then the money goes into other currencies from there. So we're very US centric in that regard. We 5 or 6 years ago ran into the kind of the buzzsaw of de-risking when decisions were made in the US, the large banks to basically exit this line of business, irrespective of the merits of the individual relationships. So given that was done and short notice was given, it threw us into pretty much of a crisis mode. And at the time I was serving at the BMA as the head of the banking supervision team, and the banks had come to us and said we need to actually get a unified strategy to communicate this concern. So we reached out to the Federal Reserve, we reached out to the remaining correspondent banks that stayed with us, and we tried to make the case of what they needed to see from us to give them the comfort that this was a business relationship worth keeping, notwithstanding the pressure they were getting from their regulators. And having been a U.S. regulator, I was with the OCC and its forerunners for many years, 27. I know that sometimes when the regulator mandates something like enhanced standards for risk management, the immediate reaction from some banks is to just start de-risking and then to show that they've taken assertive action. And I think there was some of that at play here. So anyway, after that had happened, we got very active with reaching out to our correspondent banks, engaging in dialogue, asking what kind of reports they needed to see, what they needed to see from the AML space, as far as transaction monitoring, how we were preventing potential for the correspondent banking accounts to be misused. We did have one case where one of our banks was subject of a subpoena from the Justice Department on some legacy bank relationships. So we worked through that very transparently, very openly. And we just did all we could to show that we were a transparent and cooperative jurisdiction. And it turned the tide. I believe we're at the stage now where our relationships are very solid with our correspondents. Obviously, when we look at new issues, you'll see on my slide there, I talk about some of the emerging risks that we face up here in Bermuda, and that's eventually having to support gaming. Cannabis was legalized here recently, so there's cannabis commerce that will be needing to have bank solutions for, and then there's always a specter of digital asset businesses, which we are licensing up here, but we do have yet to license a digital bank. But the issue there becoming how do we bridge that gap between fiat and digital currency and support the exchanges that we operate from here with our correspondent banks on board and understanding risk. And in many cases, probably driving the risk appetite, because we're not going to be able to step out and do that without their concurrence and prior knowledge. So that's pretty much the view from up here in Bermuda. I believe, again, we're a little bit different from the rest of the region that we're more U.S. centric because of our pay and the fact that we clear everything into, from our local currency into U.S. dollars. So that's kind of in a nutshell the view from up here. So I'll turn it back to Gavin now.
Thank you, Tom. And I think you said some really important things there before I go through the next slide. So absolutely right in terms of the regulatory drive that happened maybe 5-6 years ago. And certainly the knee-jerk reaction on de-risking, absolutely seen around the world, not just in the Caribbean, but all over the world. We saw banks de-risking. And in the Pacific, where we are, for example, we certainly saw de-risking across many of the smaller islands from many banks on a large scale, which has created some issues we'll talk about in a moment. I also think you make a really interesting point about the changing economic businesses that are the bank's customers that may create risks in the view of those correspondent banks that you deal with. And as the economy changes and as new businesses arise, whether it be certain types of drugs, or illegal drugs, whether it's certain types of digital currency, there may be views held in some jurisdictions that make those high risk from the point of view of your correspondent bank, but they may not be high risk for your regulator. So understanding that is key. And I think, Tom, that's a really good insight into what you've seen there, what you've experienced. And we have seen that around the world in terms of reduced services, certainly for smaller players. And if you put yourself in the shoes of the correspondent banks that you deal with, what are they concerned about? They're concerned about not falling foul of the regulatory regimes they operate under. And whether that's sanctions issues, terrorism issues, or money laundering issues, banks know now that the regulators have swinging powers to impose fines and other penalties if they think that there's been a failure of the controls around correspondent banking. So it's a natural reaction that we've seen. What we've seen in response globally, I think, is we have seen a move away from smaller counterparties. Certainly some of the organizations that I've been working with in the last 2 years, they're still looking at de-risking as a conversation. They're still looking at, is this relationship in our risk appetite? And there may be no change in the small counterparty, but it's very much around the risk appetite and continue to drive that risk down within the correspondent banks. And that's for existing relationships, not just new relationships where people are trying to reestablish or grow their connections. And what we have seen from the financial crime side certainly is, look, just like water finds its way, money finds its way. So where the correspondent banking networks have withered in some regions, the alternatives have become used by legitimate and illegitimate business as well. And we have a few here on the screen, so Hawaladars, MSBs, and criminal groups using alternative sources of money flow. So let's talk about how do the correspondent banks decide whether they're going to de-risk. As Tom said, that de-risking can happen quite suddenly. So most of them will have a risk view of countries and regions, and it will be linked or within their AML and sanctions programs. Some that I've seen are still very simple, and they rely upon a few inputs from regulatory sources or well-recognized third-party sources to drive a view of the risk of a country or a region. Now, in addition, there will be media reports that may hit the press in a certain country. There may be a scandal or corruption issue that gets lots of reporting in the media. That can swing a bank's view of the risk of your region, which can create problems, even if there's no direct connection to your bank. And certainly those banks that have been burnt by a single laundering, sanctions, or terrorism financing issue to do with a particular country or region can then look at all the banks that have a connection to that region that they are dealing with and treat them more harshly than they would do beforehand. A single event can actually trip the way in which they see their relationship. So what that means is that where you have an existing correspondent relationship, it can have been around for an awful long time. You can have a regular relationship. There can be, regular flows of information back and forwards. That doesn't mean that things can't change. And later on, we'll talk about how you can try and protect yourself against those unexpected changes that may be completely out with your control, not to do anything you have or haven't done, but certainly can still have a real impact on those correspondent relationships. Next slide, please. I think we're just waiting for the next slide to click over. While we're waiting, I'll have a quick cup of tea. I'm not sure if the CAB colleague can hear us or not. Oh, there we go. I saw the mouse move.
Hi, everyone.
Hello, Wendy.
Hi. Yes, we can hear you.
Lovely. Can we move the slide on one more?
Sure, sorry.
Wonderful, thank you. Thank you very much. That's good, thank you very much indeed. Okay, so look, fundamentally, if you work for a bank or another financial institution, you know that it's all about profitability. It's all about the money that you'll make, the services you're providing to customers, it's making money for the organization. And this is what it comes down to in terms of often the assessment that correspondent banks have against their counterparties. Are they profitable, and does the profit match up to the risk that they see from either that country, region, or the individual bank? Now, many of you will be familiar with questionnaires. Sometimes questionnaires are sent out directly from the bank that they've created themselves, but more often it's the Standard-Wolfsburg questionnaire that asks a range of questions around your AML and sanctions controls and asks for updates on regulatory issues and changes. It's fairly standardized. I would say that I've seen some situations where the Wolfsburg questionnaire has been completed very badly and given to a correspondent or counterparty. That almost puts you on the back foot to start with, because it's now been established for so long that there should be a very high quality of questionnaire submission, whether it's the Wolfsburg or a specialist piece. Additionally, we know that the sanctions screening regime in particular generates an awful lot of inquiries between banks, and the majority are inquiries to clarify data. They're inquiries to ask for information on a customer or an address to make sure that there is or is not an actual match against the prescribed lists. Those inquiries back and forth, there's a wide range of difference between how effective banks are in responding and providing information. And if your correspondent counterparty has to chase you multiple times to get an answer, excuse me, before they can be sure that this is a payment to release, that is a cost to them. And so some banks are getting quite advanced in how they're looking at that information about the quality of your MTs, the quality of your payment instructions, the amount of missing data, how often they have to chase you, and what sort of responses come back. But it also works the other way. If you've set your sanction screening controls too high, or your transaction monitoring controls too sensitively, and you're asking lots and lots of questions of your counterparties on payments they're sending you, that's also a cost you're generating. And so it can be the case that banks look at, well, actually, this particular correspondent relationship is generating a lot of inquiries for our customers and our our staff for little value. They obviously have not understood how to tune their sanctions or transaction monitoring systems accurately. They're costing us money and time, and therefore we need to reassess, is this relationship still profitable? So once that risk and profitability level falls, then there is usually a review internally, can be a committee, can be a business and compliance meeting of minds to decide whether the relationship is kept or not. And as I put here, it is just like any other bank product. So often there are very simple inputs that go into the decision, and it's a go, no go. And there is sometimes an appeal process where relationship managers can appeal and say, we really want to keep this correspondent relationship. But often, once you're below the line, it's very hard to come back from it. I'll hand on to Professor Cook for the next one.
Gavin, and you've given a great overview of the kind of de-risking decisions that we've seen over the past few years and the factors influencing that. There is fear of a next wave in the offing. And that in relation to proliferation financing. Now, many on the call would be very familiar with the concept of proliferation financing. FATF started to give guidance on financing of weapons of mass destruction in the mid-2000s and officially incorporated it into the standards in 2012. But frankly, this has been largely an ignored part of AML-CFT. And not even the acronyms AML-CFT broadened to also include PEF. Over the past few years, as the geopolitical picture did not improve, there's been growing concern from security quarters about the lack of support provided by AML-CFT measures in relation to proliferation financing. Now, another way to unpack proliferation financing is to focus on the geopolitical headaches, and that's essentially Iran and North Korea. That's in kind of in the key focus of international action around weapons of mass destruction. And obviously, the moment that you start thinking about those questions, the introduction of PF in FATF has been quite specific. There's a whole UN mechanism around weapons of mass destruction. But FATF focuses only on one specific aspect, and that is financing, but also financing in support of the UN Security Council's targeted financial sanctions. So the acronym that's kind of been used more broadly in the past couple of months is not only PF, but PF-TFS, targeted financial sanctions. The kind of PF-TFS aspect is not new for any bank with an appropriate compliance function. It was easily slotted into sanctions monitoring, because essentially what institutions are required to do under Recommendation 7 is to ensure that they're not doing business with anyone on the targeted financial sanctions list. So that worked well for a number of years from a bank compliance perspective. It still remained kind of under the radar. This changed last year in October, because FATF, under international pressure, adopted a change to Recommendation 1. And Recommendation 1 is the fundamental recommendation that governs the risk-based approach in all of the FATF standards. And this is a very specific amendment. What it requires is broadening the risk-based approach that we have in respect of AML and CFT, also to PF-TFS, but in a very specific way. So normally with AML-CFT, you do your risk assessment. Where risk is higher, you enhance your controls. Where risks are lower, you simplify them. It's the same model, except for the simplification part. Where there's higher risks, you enhance your controls. Where there's lower risk identified, you cannot do less than is required in recommendation 7, which is what institutions should be doing currently, and that is making sure that you are not doing business with anyone on the sanctions list. In kind of from a paper perspective, it looks like a very small addition to what's already done. And I attended some of the FATF reach outs regarding the proposed new guidance that they are issuing at the moment. And the Wolfsburg banks were there, and they were very careful to signal to FATF that nothing of this is new. They've been doing this all along. It's part of what they do. But we heard very little from smaller banks and regional banks. So what's the problem? We expect that FATF will finalize their guidance on PFTFS risk assessment and risk mitigation in the June plenary, literally in the next few weeks. And then these measures will kick in. Now, from I think a logical perspective, what will need to be done is every country will need to take the lead with a national risk assessment on PF. Most countries haven't done one yet. And that national risk assessment will inform industry risk assessments. But it's not clear that the big banks will wait for smaller countries to first do their risk assessment, to then inform institutional risk assessments. Looking at the world from their perspective, they've been doing this. They have their own PF risk assessments, and they will be asking, so what is the PF-TFS risk that my correspondent banks are bringing into the system? We've had various discussions with FATF and other stakeholders over the past few months, kind of pleading for a special regime for smaller institutions. That has not been accepted. Pleading for more information coming from FATF to guide institutional risk assessments. That ball has been kicked to governments, but also to industries, because there's a very real possibility for industry associations to start taking the lead on behalf of the smaller institutions, and to kind of inform the space with information. Moving on to what else can be done at a regional and at an industry level, speaking from our neck of the woods, Gavin, here in the Pacific. The Pacific shares many of the de-risking concerns that we've listened to coming from the Caribbean. As a result, the Alliance for Financial Inclusion's Pacific arm, called the Pacific Islands Regional Initiative, PIRI, the Pacific Committee within the Alliance for Financial Inclusion, launched their own de-risking action plan that they currently unfolding, including regional initiatives around a regional EKYC facility that's being led by the Australian and New Zealand Reserve Banks, with donor funding and assistance for island-based banks. But we also see regional initiatives to build and enhance capacity, to signal to global banks that there's the necessary capacity, necessary infrastructure on the ground, and as in the Caribbean, also a much closer look to the use of technologies to support appropriate compliance. And it's great to see also similar leadership emerging from the Caribbean. The ECCB, for instance, the ECCU has been working towards what's now known as a collaborative CDD model, a shared services model, specifically focused on a shared risk and compliance function for ECCU banks. Now, these are the types of of regional initiatives where institutions work together, not only to cut costs, but also to increase effectiveness, and from that stronger platform to engage global banks to keep these channels open that really hold a lot of promise. And then also other regional developments. Jamaica National Group launched JN Bank in the UK last year, the first Caribbean-owned bank in the UK. And it's clear that they also are very concerned about lots of correspondent banking relationships and view that as a role for themselves to help banks in the region maintain linkages with the UK and further. So just a few regional perspectives, but back to you, Gavin.
Thank you, Louis. Very interesting and very helpful. I would take issue with one line you said there. You said that larger banks have been handling sanction screening for a number of years and it works well. I'm not sure I'd say works well. I think it works. And we're going to look at some examples of failures now, and some of these involve quite large banks, to be frank. I'd also say that the false match rate for sanction screening is still, if you're doing it industry average, you're looking at 98, 99% false hit rates, which is pretty substantial.
Absolutely, Gavin. But and it's great that we kind of get your perspective as an industry insider who's worked in negotiations, say at international fora, and they exude confidence about these systems. Now, we know that most of the banks in those groups have been fined for AML-CFT failures somewhere along the line in the past few years, but that does not diminish the confidence with which they put this message forward in the discussions with international standard setting bodies. Thank you.
Absolutely right. And I think that's very true. And I'm not saying that the screening at the larger banks doesn't catch an awful lot of potential sanctions or TF or money activity. Absolutely not. What I'm saying is that, as you know, at Digital Financial, we deal with a wide range of clients, and we see a lot of activity and a lot of work around this issue that doesn't generate a lot of positive results in terms of the energy in and the energy out. Let's think of it that way. And we've got two examples here. And we put these together because I thought it'd be useful for the audience to think about, could this happen to me? Could my bank be on one side of this equation, and how do I stop this happening? So the first one, I've used Bank A and Bank B to protect the guilty, obviously, use some alternate names. So you had the Bank A send a payment, their customer is legitimate. There is no question mark around the underlying business. There's no TF risk, no PF risk, no sanctions risk, via Bank B to the USA. Now, Bank B's screening systems highlight a potential match with an address field. They need more information. RFI goes back to Bank A. We need more information on the address. We need the full address. Who's it going to? Now, due to a breakdown in the communication systems in Bank A, the inquiry from Bank B never got back to the business, to the front line, therefore never got back to the customer. There was no response from Bank A to Bank B. Bank B had a policy standard that if there wasn't a reply within 14 days, it would be treated as a true match and there would be a report made to OFAC unless there was other overriding information. And the policy at Bank B was that if the same customer sends money to the same destination, that will also be stated as a potential sanctions breach and reported to the regulator. So what do we have here? Well, because of a breakdown in Bank A's internal processes, we have a non-risk issue that generates work for Bank B and creates regulatory issues. Now, Bank B may then take the view, Bank A is just creating cost and regulatory risk for us. We don't know whether there's actually a real sanctioned risk underlying this, but put that to one side. We now have to report to the regulator every time this type of payment comes through, and it's costing us time and money to chase down. Is that relationship worthwhile? So that's the sort of issue that can arise and risk that can arise for you very quickly if there's a failure, if you're Bank A and there's a failure in how you handle the inquiries and deal with the customers. And of course, sometimes customers won't respond. So even if you follow your internal process and inform the relationship manager, you may not get a reply from the customer. You have to think about, do you have a process for engaging with Bank B in this case to let them know what you are aware of to try and minimize the risk of a negative outcome. Okay, next slide, please. Thank you. Okay, so I mentioned the false match rate across most organizations is up in the 98, 99% range. And the reason is that the sanctions list, the prescribed list, the entity lists have a lot of words in them and they are screened against. And there's a lot of fuzzy matching and trying to catch deliberate misinformation in message fields. And this throws up a lot of potential matches against words, acronyms, and other information. And we have a case here where Bank C sends a series of payments. Again, the underlying business is completely legitimate. There is no laundering, terrorism financing, proliferation financing, or sanctions risk. Bank C knows their customer. They've done their work. However, Bank D raises a question because in one of the descriptor fields, there's a acronym ISIS, ISIS. So a request goes back. Now, Bank C in this case does act on the inquiry, confirms with the customer what it stands for. It stands for the offshore operations of the customer. They used it internally for years before ISIS was on the world stage. And therefore, there is no underlying risk issue here from Bank C's perspective. Bank D understands that, they process the payment, it's a false match, fantastic. However, Bank C does not take the opportunity to have a conversation with their customer to explain how that acronym may continue to create risk for them, not just with Bank C, but other financial institutions they deal with. Every time you send a payment, there is the risk that somebody may say, this is a concern, and may delay or freeze or reject a payment. So Bank C has a failure in one perspective. Their system isn't adjusted and continues to highlight, alert, and escalate against those acronyms when they come up. What that means is that from Bank D's perspective, Bank C is creating work every time there's a payment with that acronym coming through. And if they start looking at the metrics on which banks they have relationships with that are creating work and are creating potential risk, then Bank C may be up there for discussion. I know it sounds a bit illogical, but in a large organization, that's sometimes how these things are worked through. Now, I should say here that if Bank C goes to the customer and says you should stop putting the word ISIS in your payments, there is a real legal risk there. There are very clear cases, historical cases, where banks have been penalized and fined and otherwise censured for giving advice on customers on how to avoid or evade the sanctions and other controls. So I do want to say to delegates listening, we are not suggesting at all that you should go to customers and advise them on what words to include or not include in their transaction requests. And legal advice should be obtained if you have a situation where you think there needs to be a conversation. So a bit serious, but very important to understand that. But the point here is that there's lots of ways in which your legitimate business can create risk in the mind of your correspondent banking partners. And you have to think about that. It's not enough to say, we know our customers are clean. You've got to think about how do we make sure we minimize appearing on that top 10 banks that are causing an issue for our correspondent relationships. Okay, next slide, please. Okay, so in terms of a playbook, so what can you do if you're starting today? What can you do to try and minimize the risk of there being a problem with your existing relationships, or indeed to grow new relationships? And Louis mentioned some opportunities out of the UK, which I think are very positive. The first is you have to be able to document and explain your AML and sanctions programs in detail. I remember being on a call with a small bank in Asia, probably about 8 or 9 years ago, and we were discussing with the compliance department their AML program They'd sent through the questionnaire, they'd sent through information on their policies, but the compliance officer was not able to explain the risk appetite of the bank and was not able to explain how their controls had detected and prevented risk. So being aware of where your program is and also being able to demonstrate that you've improved. I know a lot of banks in your region have definitely done a great deal of positive work in recent years. Being able to explain that is very, very important. Likewise, being able to explain how you understand your risk base. How is your customer base segmented? Where are the risks? How do you mitigate those risks? So you need to understand your risk so you can explain it to the correspondent banks if they ask questions around it. The third one's really important. I think this is more and more important. You have to be able to handle those inquiries very, very effectively. The more time it takes you to act on an inquiry in relation to a payment, the more likely it is that there are going to be question marks raised against the relationship. Fourth point, a simple one, which is you know that questionnaires are going to be requested, so have them ready and have them looked at by an independent pair of eyes. It might be a peer that you have that you trust. It might be an independent firm such as ours. It might be a working group that you're part of, but having somebody to look at it afresh and ask questions and be that hostile examiner of your questionnaire. I've seen a lot of questionnaires where there is, believe it or not, where there is a box ticked yes that should be ticked no on a very simple question, such as, do you have an AML program? I've seen it tick no when they meant yes. So those simple errors can really catch you. The last point is on this slide is really to educate your customers and your staff. So educate your staff on the importance on acting on inquiries and educate your customers on whether there is a transaction request or a payment request, that all the information is completely and accurately included. So I put measure twice, cut once. So having a way, I've seen banks moving to this more, having a way of checking the payment instructions from your customers before they're sent out to make sure they have full name, full address, country information, that if there are acronyms, the acronyms are clear, for example. So what are we seeing going forwards? Well, look, Tom, Louis, and myself have given you a bit of doom and gloom over some things here, but I would say that there is some positivity we should be aware of. So we've heard about some new opportunities out of the UK in terms of correspondent banking potentials. We've heard of the real benefit, I think is really exciting, around the communal KYC services. That's a real plus point that should be stressed strongly. And also we've heard from Tom about how the US and other administrations have recognized the importance of your region and the importance of not allowing de-risking or knee-jerk de-risking to drive the conversation. Now, the thing you have to remember is the regulatory pressures are still very high for most banks in this field. Regulators are increasingly sophisticated in understanding or seeking to understand how those banks are managing their risk and want evidence that they're actively managing their risk. Actively managing their risk means eliminating risk in some situations. So that's why there's going to continue to be a pressure on this. But it is really to do with the perception of your organization in these correspondent relationships. And perception is key here. Many of these banks you're dealing with will have hundreds of correspondent relationships. They do not want to spend time on those relationships that they think there is no or little risk with. So the more you can shift the perception of your organization down the risk curve, the better it's going to be. And the final points I'd say here is that, look, we've seen a lot of organizations struggling with this issue of correspondent relationships, sanction screening. You can prepare a great deal internally, but you've got a great resource here in your region with the CAB. You cannot do this alone, or you cannot do this alone easily, I should say. So do not hold back, and that's the message to finish on really. Do not hold back, continue to use your colleagues, continue to use minds such as Thomas and Louis and myself. And I am sure there's a lot of opportunities here for all of the banks looking for stronger correspondent relationships. But you've got to be realistic as well that this is something that does require dedicated effort going forwards. Okay.
Evan, could I just add a parting word from my vantage point?
Absolutely.
Yeah, I just want to make the case because I spent some time also on the inside as working with correspondent banks at a bank level. And you were right, many of these correspondents have hundreds of relationships and they don't want to be chasing down false hits on transaction monitoring or sanction screening, because that creates what they call friction. So you have to do whatever you can to reduce those friction points so that it's more of a seamless, when you put transactions through, your rules and your screens pretty much mirror or reflect what theirs are, so that you have that symmetry. When transactions move through, they move through without friction. And this way you're not raising flags on their risk screens. And it's very important because you don't want to stand out for that reason. And I would also mention that our experience here is that banks that specialize in custody, safekeeping, seem to have more sophistication and systems and monitoring. And they seem to be the ones that stuck with us during the tough times. They've understood us the whole time. So, I would just close.
Yeah, that's very true. Before I turn to Louis for a little wrap up, we haven't covered a great deal of trade finance and asset sanction issues on the call. We've been talking more about correspondent banking issues. It is absolutely true, Tom, that I think that the trade finance and the screening approaches there and the screening of the payments related to those trade finance events are increasingly a focus. Because it is a complex area. There's a lot more information to miss or to see. We're actually covering in Australasia. We have a conference coming up next month in Sydney where we've got a specific session on trade finance, because it is, I think, so important to banks to understand how to raise their game in that area. But thank you, Tom. Louis, is there any closing remarks from yourself?
Gavin, just listening to you, I recalled a discussion about 2 years ago that I found myself in. A small bank from a country that found itself de-risked by a European bank, and it was the two CEOs of the banks. And the small bank CEO said, I received this letter from the bank giving us a month to find another banker. While I was reading this letter, I was looking up at a picture on my office wall, which was actually some of the first correspondence between the then CEO, who was my grandfather. It was a family-owned bank. And I immediately reached out to you and to your office, and it had no effect. And I think it had no effect because some banks are very good at speaking banker. They're very good at these at the upper level relationships. Well, these decisions are driven by risk, and you need to speak and think risk. And what you've done is kind of just hold up the mirror to say, stand in the shoes of the other person and look through their eyes at what you are pushing through the channels and mechanisms. The CEO discussions are important, but the CEOs generally return on de-risking and say, we are so sorry, we don't want to do this, but this was a decision taken by the board based on advice from the risk manager, and we had no option. So it's important to have good relationships at the top level, but if you don't manage your risk relationships and the views of your risk, that relationship on its own is not going to help. You need both. Thank you.
Absolutely right. 100%. 100%. Thank you. I think we're moving to questions now. Wendy, I wonder if there's a format you'd like to follow in terms of which questions we tackle.
Hi, so sorry. So I was on mute there. So let's see. I think we have one question and one comment. I think Earl Gill is still with us. So Earl, would you like to voice into this one?
Sure, yeah. Let me just say that, that was a great presentation, guys. You covered a lot of good stuff. And for someone who's worked in the field, let me just say, I've identified with some of those areas that you spoke about, where there was a lack of training and a particular transfer was sent to a particular bank. It got flagged through a head office. And the next thing I know, the head office was on my case, wanted to know what was going on because they could lose their license because of this. And, that particular account was flagged. We always had to address anything that account generated. So the point there was really a lack of training, a lack of understanding of what compliance was all about. But anyway, to my point here, there's been a lack of confidence in respondent banks to manage risk and to enforce regulations, coupled with the fact that the Caribbean does not currently have a scalable, robust, recognizable compliance platform. I know the ECCB is starting to work on this, right? But what resources and programs are available to assist the Caribbean to attain a better reputation, seeing that there's a significant potential disruption of financial services across border flows? Like the issue within the Caribbean is not just within the Eastern Caribbean, right? It's right across the entire region. So how do we get the region up to par as fast as possible? How we get the correspondent banks having confidence, in what we do, because it does disrupt the economies of these islands.
Sure, I'll answer that first. I'll turn to Tom, and then Louis probably tell us if you can how they've tackled that as well. I think, as I said, there's a real strength in numbers here. So both through the CAB and other regional organizations, there's a benefit to sharing experiences and developing. I would suggest you could look at developing some of the standardization responses to questions, making sure that you all speak the same language when you're dealing with those inquiries, to having maybe some good practice developments. I'm working with another industry at the moment to develop some good practice guidelines for all of their members, including guidelines to the boards on how a strong AML and sanctions program can be in place. Now, it's not prescriptive, but that sort of lifting can be a real benefit. And I think, look, you've got a fantastic group here through the CAB in terms of being able to have that unified approach. But that's from a kind of organic, that's how I'd approach it from organic side. I think, Tom, you might have some views from your
apologies. I would echo that what Gavin just said, and you have to operate collectively. You have to get together. You can't have banks going in different directions on this. You have to have a uniform messaging and pursue that solution. And in your case, you have the ECCB arrangement, and that would be the best form for getting this initiative done or undertaken. That's it for me.
Thank you, Tom. And perhaps coming in on the same question, there's a great benefit in being a region. But the downside is also that everyone in that region is lumped together under one label. And that's part of the problem with the Pacific. Like the Caribbean, it's the different constituent parts are very different. You get large islands, small islands, often with no real commercial linkages between them as a result of distance. That's part of the Pacific, not so much of the Caribbean in that regard. But in the eyes of someone sitting in Europe or sitting in a big country, this all blurs to one region. Looking at it from the region, you understand the nuances and the differences between the different role players. They don't necessarily get that. I love compliance officers. I've trained many of them. I've worked with many of them, but they often come from different disciplines. They don't come with that geographical knowledge to help them differentiate. So for the Caribbean, what would stand out for many is the fact that some of the regions or some of the countries, they are currently on the grey list, both in FATF and the EU. And that's a problem. And their problem suddenly becomes everyone's problem under that label. So as a result of that, it makes sense to take action together. It makes sense to help countries prevent being grey listed, and once on the grey list to move off very quickly, and to communicate about the levels of sophistication, the differences. So while you work together, also kind of work together on messaging, and work together on who needs to get the message. And that is what Gavin focused on. And how do you sell that? Now, you can't sell a message. You can sell improved processes. You can sell what you've done and how you are dealing with risk. And if there's risk in the region in relation to specific jurisdictions, how do you in another jurisdiction manage that risk to ensure that your correspondent bank is not affected by it? Because that is what they want to know. Thank you.
I would add, make best practices the common practice.
Can I jump in here?
Please.
Okay, yeah. So I mean, I think those are all very relevant points, but I'm trying to take a view of what can I do in the very short term to raise credibility, with the way I do things, and I come back to training because I think from my past experience in the field, having worked in numerous locations for many moons in different roles, that maybe a fair percentage of the problem is a lack of training and for our frontline people and our operations people not understanding what risk is. So for argument's sake, you're opening a new account, but the customer service officer or whoever doesn't really understand the type of information you should be gathering to mitigate risk or to confirm that that is an appropriate type of customer with an appropriate type of transaction. So there's a lot of work to be done. I mean, you can do that, and it's all about reinforcement and keeping that going. And then you get to the stage where your systems would flag the exceptions and then have that oversight, that regulatory oversight, that sort of those controls in place. But I'm feeling that there's probably a fair amount that can be done just from a training perspective, an understanding perspective, through your sales processes, through your operational processes, to help to strengthen this whole thing. I could be wrong.
No, Earl, I think you're on. Training is always a recurring need. Navigate through the customer service person through the process, raise the appropriate questions. I saw a drastic difference when a new onboarding system was put in place at one of our banks that then we're able to train the people around that system, and the onboarding process became much more effective and much more compliant with AML regulations.
I think that's right, Earl. It's a very good point to make around training, and look, training is very important. But I think Tom's point about process and systems is also critical. And there are some simple things you can do. For example, if you have a online banking service where customers can raise payment requests online, does your system have, simple example, a pop-up before they press send that reminds them to make sure that the full name and address of the beneficiary is clearly included in the instruction? Does your system not allow, for example, a payment request to be sent if there's a blank in the name field? So there are some process issues that can be thought about. Now, it's a combination. It's training, process, and systems together to get those quick wins individually. But But I think the overall message you should be hearing from all of us is the collaborative efforts for the region are going to also be a huge lift.
Very briefly, just to come in on that point, perhaps a starting point might be to accept kind of mutual standards of how to do it in the Pacific. The key banks agree on key points or issues that they will incorporate into their systems and that they will adhere to as an agreement with themselves from a regional perspective and an undertaking to their correspondent banks. And use that as a kernel to build better practices.
I also saw a question from Lisa, I think, around, and we've discussed before the issue of risk slicing the customer base, and I think I mentioned in passing the importance of understanding your own risk. If you're looking for a new correspondent relationship, then being able to explain that you've identified the highest risk areas of your business and your customer base, and being able to explain how you can tailor the business through that correspondent relationship to avoid any types that your correspondent counterparty would be very uncomfortable with, is one way to have to build that discussion. For example, they might say, we cannot handle any payments going to the Middle East. End of story. Doesn't matter which country it is, we're not doing any payments, east of a certain line. So if you can show that there's a way in which you can respond to their risk concerns, that can build the relationship.
Gentlemen, we have a question from Don. Which area of regulatory compliance is typically the most challenging? People, process, or technology, a combination thereof, factors in the playbook?
Which area of regulatory compliance is most challenging? It does depend on the regulator, I have to say. Different regulators have different appetites, and it also depends on what has been in the news in the last 12 months, because regulators do sometimes change their focus. In my experience, having done this for an awful long time, I often see very good policies and procedures, and yet I see time and again a failure in effective implementation. And you see compliance officers who have a great policy on the shelf, they pull it off, they can show it to the regulator, regulators are very happy with it, but when they actually go and look under the hood, the car doesn't work. And so I think it's that process, that compliance with your own standards, that is where the regulatory risks lie for many organizations.
It's interesting because it's somewhat similar to the conversation we were having earlier regarding M&A in terms of doing your due diligence and ensuring that all of the T's are crossed and the I's are dotted. Gentlemen, we're coming towards the close. We do have another question from Don, which I'd like to hear your thoughts on. Any thoughts into validation and verification processes for sales and oversight? You got that one, Louis?
Yes, well, I'd love to hear Gavin's thoughts on that, because he's been so close to these processes. What would you say, Gavin?
To be clear, are we talking about validation and verification of customer information, or are we talking about other information? Don, is there any?
Don can clarify. Don, you want to clarify by voice, or are you able to just type in? And I think we have one more comment from Earl as well.
Should we jump to Earl while Don might want to add to his question? Because I don't want to give the wrong answer, misinterpreting the question. Maybe Earl,
yeah,
do you want to?
I've asked both to come on.
Hello.
There we go. Yes, sir. Proceed.
Hi, Al.
The floor is yours. Go on, Earl.
Sorry, I think that something, I wasn't really posing a question at that
Oh,
time.
you had your hand up.
I'm sorry, you know, like maybe I just touched that
Fair enough.
in error. My apologies.
All right. Okay. But yes, so gentlemen, I mean, broadly speaking, I think we've really built on the first interaction that we had a few weeks ago. But what do you see as being the principal challenges, especially Thomas, you from the Northern Caribbean facing our jurisdictions, and how do you think we can? You spoke about working together, but how do we? What are the key indicators? What are the key thought processes that we need to engage in order to move forward? Thomas, you're on mute. Thomas, Tom, you're speaking to yourself. Let's see if we can get you. I think we should have you on now. Go for Tom.
I think your mic might be. I would say we got through an hour with no technical issues, so it's very fortunate it's come right at the end. Tom, I can see your, yeah, Tom, you're not muted but yeah, we still can't hear you, so your mic issue.
I think that just might be our cue to start wrapping up, gentlemen. So I think I'll invite Gavin and Louis, which of you wants to go first to provide us with some closing thoughts?
Louis, you go first.
I thought let me go first and then you wrap up, Gavin. I'm really excited by a number of ideas that I've heard in our engagements over the past few weeks. Yes, on the one hand, the picture is changing. There are more positive opportunities on the table, but there are also a few storm clouds that you do need to keep your eye on. I think it's important to get a plan. To get a plan as a region. It doesn't need to be the most ambitious plan, but it needs to start because the clock is ticking, and that's both on the opportunities and on the storm clouds. And we are navigating globally kind of difficult waters. Starting with core plans where you can support one another, but you can also start building the improvements in the quality of controls and risk controls in the region in order to communicate that appropriately to correspondent banks, I think would be important. And all of those parts are important. You can't communicate and give confidence if there hasn't been improvements or there aren't really credible plans around improvements. But once you've got the improvements, unless the communication is also sensitive and directed, and they're not going to be as productive. And some of them may actually be counterproductive. So it's kind of getting these moving parts and bits in place, and trying to collaborate, because there's only so much that you can do individually as institutions to improve the picture if there isn't also some movement towards improvement by counterparts and by the region as a whole. Gavin.
Yeah, I think it's absolutely right. I'd also say that when we talk about plans, I would say that as an individual organization, an institution, you have to be realistic about the risk here. And that risk could be severe if you lose your existing correspondent relationships. And therefore, having an honest assessment of where you are today in terms of your AML program and your risk, really understanding the risky parts of your business that might cause you problems. And if you don't have an understanding of that today, or you did one a couple of years ago and haven't updated it, then I'd say that's the first thing you should be doing. Now, you need to do that for your AML programs anyway. You need to understand your risk and have appropriate controls, etc., yada, yada. But really being able to demonstrate and talk to your senior management and the board about, okay, we've got a fantastic bank, but this proportion of customers over here is creating ongoing risk for us because ABC, and it puts our correspondent relationships in jeopardy because DEF. And here's some ideas on how we can minimize that risk. So alongside the collaboration and the regional lift, which I think is absolutely critical, as Louis has said, for your own businesses, you have to really assess and understand and document and cut out, if you can, the parts that are going to cause problems. Because as Louis says, there are hurricanes on the horizon, and you want to make sure that you avoid them as much as possible.
Thank you very much, gentlemen. I think we've had a very informative discussion this afternoon. And once again, you guys have been absolutely tremendous. I'd just like to close out this afternoon by introducing you to another of our sponsors for this masterclass series, Raymond James Financial. Raymond James is an American multinational and independent investment bank and financial services company. They provide financial services to individuals, corporations, and municipalities through their subsidiary companies, which engage primarily in investment and financial planning, in addition to investment banking and asset management. So today we're going to be introduced to Raymond James, not so much in terms of their products and services, but more so just in terms of their culture.
Simply, we are people-driven, values-built, and future-focused. Just as we say in our mission statement, our business and their financial well-being. This idea started with our founder, James, that people needed more than financial products. They needed someone to help them plan for their future. Today, we continue to help individuals, as well as corporations and institutions, achieve their goals. We develop and support successful professionals, and we help our communities prosper. From that mission came our values, the foundation of our cultures. We believe in putting clients first. By our clients, the firm will do well and will all benefit. We act with integrity, placing others above ourselves, and what's right above what's easy. We think long-term, acting responsibly, and taking a conservative approach to ensure a strong, stable firm for years to come. And we value independence, respecting autonomy, celebrating individuality, and welcoming diverse perspectives. These values are our pledge and promise to clients, to advisors, and to each other. And while we're grounded in our people-driven mission and our core values, focus on the future. Our vision is to be a financial services firm as unique as communities through the power of personal relationships and professional advice. As we fulfill this vision, we'll be recognized for things that matter. Treating people well, producing strong, stable work, and providing quality solutions and outstanding service. Our mission, values, and vision add up to our culture, a culture we're committed to preserving through our everyday actions and the decisions we make for the future. That's why we've memorialized our culture in a living document we call our blueprint. It's a guide that shows everyone associated with our firm what matters here. Because we know it's up to each of us, all of us, to bring our culture to life. the culture that makes us Raymond James.
And that was a short introduction to our partners at Raymond James. And once again, we'd like to thank all of our panelists today from Digital Financial. I think that is still, my apologies, that video is still running there. But yes, so I'd like to just once again thank all of our participants this afternoon. You've been very, very insightful. So once again, thank you to Mr. Bruce Bowen, Mr. Jim Meek, Mr. Dalton Lee, of course, the chairperson of the Caribbean Association of Banks, Gavin Coles, Dr. Louis de Coca, as well as Thomas O'Rourke from the Bermuda Bankers Association, for being part of and enriching the CAB Masterclass series. Thank you, and do have a good evening or good day wherever you may be. Cheers.